Welcome to the Brain Picker Pro Show, live from Lake Wiley, South Carolina. I'm really excited on today's show. We try to give you a variety, a lot of different things out there. You guys all know what I do. Day trade real estate, seller finance real estate. I've done just about everything there is to do over the last 30 years. But today is a special guest that focuses. Now, he's done a lot of stuff too, but he focuses primarily on mobile home parks. And we're going to get into all the details and everything about it, but I'm really excited to have him on today. I've been excited when I found out I was going to get him on here. Been excited about this. So I've got a lot of questions myself. So please give a warm welcome to Kevin Bupp. What's going on, buddy?
Oh, Larry, I'm doing great, bud. Thanks for having me on. Looking forward to it.
Awesome, man. Thanks a lot for being here. Why don't you start out and tell our viewers and listeners, by the way, guys, please share this. Please share it and please tell everyone about it. Please leave us a review if you like this. It's all good, free content information. So we appreciate you watching or listening, and please share it and leave us some good feedback if you like it. So why don't you tell our viewers and listeners a little bit about yourself?
Yeah, no, absolutely. So it sounds like just like you, Larry. I've been doing. I've been a full-time real estate investor most of my adult life. I accidentally became an investor. I wasn't looking for it back when I was 19 years old. So I'm very grateful and blessed for that experience and the opportunity to meet someone that was a full-time investor and kind of show me this beautiful world. And so I was in school at the time, community college, not really having much direction other than felt like I had to get a degree. And met a guy that was about 20 years older than I, and he was a local real estate investor. Had owned at that point he had owned pretty decent portfolio of single family and smaller multifamily properties, and lived a pretty cool lifestyle. I was raised in a blue collar family. Never really went without, but we didn't have a lot. My parents didn't drive fancy cars, and we lived in a very normal neighborhood. Again, never went without clothes on my back or without food on the table. But David, who's this guy, he became my mentor. He had a slightly elevated lifestyle, very nice car, seemed to have a lot of flexibility in schedule, traveled a lot, dressed really nice. I took a liking to that, not for the material aspect of it, but just I saw it as a place I wanted to be, and I saw it as an opportunity. And so David also must have saw something in me in that he actually invited me to a real estate conference, a 3-day boot camp that he was going to in Philadelphia. I'm from Pennsylvania. That's where I grew up. And so this was Ron LeGrand. Larry, you're probably familiar with Ron LeGrand. You've been in this business a long time. Ron LeGrand's been teaching for a very long time. It was Ron LeGrand boot camp on how to fix and flip houses. And I had no idea what I was getting into. I'd never read a real estate book. I didn't understand it at all. And this was like 2 weeks after I'd met David. Him and I befriended each other, and he invited me there, and I went. And I left that conference confused, excited, scared. I mean, a whole bunch of different mixed feelings. But what I did know is that I met a lot of people there that were making a ton of money, and I didn't feel like they were any smarter than I. They knew more than I did, and with regards to that particular niche and that specialty of fixing and flipping homes. But I didn't feel like they were any smarter. Their IQ wasn't higher than mine. And
Right.
so ultimately, I went back to David. I said, David, I got to learn how to do what you're doing and what these people are doing. How can I help you? Right? How can I, in my spare time between tending bar and going to school, that's what I was doing. I was tending bar to make money at night and going to school. How can I help you in your business? How can I be around you and learn what it is you do on a daily basis? And he accepted the offer, and that's what I did. Literally every waking hour that I wasn't at school or at work, I was at his either home office or on the road with him, or you meet with a contractor, helping him with paperwork. Basically, I was an admin. I did whatever he asked me to do, just so I could be around it. And that's what I did for about a year. And then ultimately, I was chomping at the bit to do a deal, and I bought a really rough, rundown row home in the city of Harrisburg, Pennsylvania, where I grew up. With money, with a private lender, who was an introduction from David, and with some money I had saved up tending bar, and renovated that property. I flipped the first couple of properties I did because I needed my money back. I wasn't really at the point where I could hold on to it for cash flow, and so did that for a couple of deals. He did not partner with me. Did it all on my own. He was there to help me and give me guidance, but he surely kind of left me do my thing and let me take some risk on myself. And it was scary as heck, and I made money on the first couple of deals I did, and morphed that into what became a bigger company. And so that was like '01 era. I moved down to Florida in 2002, which is where I'm at today, down in the Tampa Bay area, and really, that's where my business scaled. It was a new world down here, bigger market, and things were hot. This is '02, so the roller coaster ride was going up, and just started buying a lot of homes. Really started focusing on holding property and creating a portfolio for cash flow, which is that was David's business model, right? So I was just emulating what he had taught me,
Right.
and did that. Started buying, lots of single family homes. Had a very large portfolio leading into the Great Recession. Also started buying apartment complexes back in '05, leading into the Great Recession, and ultimately lost pretty much all of it during that crash. Over a period of 12 to 18 months. Even my primary residence, bank accounts got garnished. It was a rough time, and ultimately rebuilt myself a few years after that, and started focusing on mobile home parks, which is where we're at today. So that's kind of the condensed version of the story. Lots of other things that happened in between those time periods, lots of other types of real estate and businesses that I was involved in, but real estate's always been my core. It runs through my blood, and I can't imagine doing anything else.
That's really cool. I love real estate because there's so many different things you can do with it. So I'm assuming that during those times when you were laughing and crying and, losing properties and the market was crashing, I'm assuming you figured out what it was that you did wrong so it won't happen again, right?
Yeah. I don't think there was any laughing involved at that point, but probably crying and I wouldn't say depressed because I'm a pretty happy person generally speaking, but it was a little rough. I'd never been through anything like that before, and it felt like everyone I knew that were I considered to be smarter than me or older that had been through this before were also losing their behind, and so it was. It was a challenging period that I couldn't see the light through the tunnel at all. But in any event, looking back, it took me about 2 years, Larry, to really look back. I mean, it was a disaster. I don't even know how else to put it. Like literally my personal bank accounts, I tried to, I made a strategic decision at some point because I knew I was going to be out of money very quickly and I wouldn't be able to literally feed myself. And so, I kind of set aside, a nest egg to get me through this down period. And that bank account got garnished by one of the creditors. And literally, it was really, really ugly. And so I stuck my head in the sands for a couple of years and just, started 2 other side businesses that were non-real estate related. They were health and fitness related. That was really something I felt I could control was, how I felt and, my mindset. And I didn't really want to think about real estate because I kind of blamed real estate for the issue and that challenge. And we all know the buy low, sell high. It's really hard when it's your blood that's in the street. It's really hard to get yourself out of that bubble and look and say, now we got to get going. Like now there's opportunity, Wow. And I think the second time around, if it would happen again, I think it would be a completely different. Now I know, but I didn't. I was young and naive and whatever. So looking back, trying to determine what happened and what I wouldn't do again. And this is nothing related to residential single family homes because that's what majority of my portfolio was made up of. And I don't blame residential single family homes, but I blame my investing style and I blame where we owned real estate. So we owned it here in Southwest Florida. Taxes are incredibly high. Insurance is really high with hurricanes and such. Sure. And so it was a very difficult cash flow market. Even though we made cash flow, and our loan to value was very low on our portfolio, our rental portfolio. It was a very inefficient business to manage when we had properties in 3 different counties. Just the leasing process was inefficient. And I know a lot of the big REITs have figured that out, I think, right. But it was inefficient. They weren't really strong cash flow machines is what I thought. And then in addition to that, down here, it's a little bit of an anomaly. And I think Arizona and Nevada and a few other states got hit really hard like Florida did. We had a lot of spec builders down here building rooftops by the thousands and basically kept building for populations that weren't really coming at that point. And this is back when, I don't know if you remember, Larry, you'd see pre-construction homes get flipped 3 times before they ever even before a nail was even, hammered into a board. That was happening down here.
How to buy pre-construction.
Yeah, it's crazy.
Once it was done.
So what happened down here, the big thing, which I don't know what I would do differently other than probably not build a portfolio of homes down here or in a market like we were in. But there were a lot of these brand new 322s, 422s that were built. A lot of builders weren't selling them. And so they started renting these things out. And we literally were getting poached. I mean, they were renting them for, for $1,000 a month. You could rent a brand new 322, whereas we were renting a 25-year-old 3-1 for, 900. And so we were getting, kind of this mass exodus. We're getting people that weren't renewing leases. They were bailing out early, moving into these other, these brand new homes. And so we had an occupancy issue, which basically just took away all the cash flow. And we were having to basically make rent concessions or lower our rents to get these things reoccupied. And so it went from a positive cash flow to a negative cash flow, to where we were writing checks each month to meet our debt service. And it wasn't sustainable. I mean, it was, and I didn't know how long it was going to last. And so that was, I don't know what I would have done differently, Larry. Like, it's funny, I've been asked that question many times, other than nowadays when we buy mobile home parks, when we buy any type of property, but I mean, mobile home parks are our specialty. We run them through multiple different modeling scenarios to where we run them. We create very stressful hypothetical situations of, if it's a 5-year balloon note, what happens if the rates go from the 5% to 8%? What happens if we can't get cash out? And that's kind of what we're projecting to get some of our investor capital back. What happens if we can't do, 3 to 5% annual rent increases for the next 5 to 7 years? Like, what if we have to skip 3 years? Like, what happens? What is the worst case scenario? What's the threshold to where this deal doesn't make sense? And then can we get comfortable with that? And so I never did that, right? I never ran through these catastrophic scenarios before. And if I would have, I probably would have seen some of the risk, but a lot of people didn't, right? A lot of people got hammered as unexpectedly as I did. And ultimately, it's just changed our focus. And I'm a smarter investor because of it. And I've learned a lot, and I've taken lessons away. I think that's the most important thing, right? Take the lesson away from the experience and apply it to your life moving forward. And so I wouldn't change a thing.
That's awesome.
It would have been hard to say that back then, but I surely wouldn't change a thing looking back.
It is difficult to say that when you're going through it.
Absolutely.
Totally get that, and I totally understand it. But, it's the school of hard knocks. It's the best education there is. So let's jump right in with the mobile home parks. There's a lot of people out there doing even multifamily. Why mobile home parks as opposed to something like multifamily or another type of vehicle?
No, that's a great question, and I tell you that I told you I stuck my head in the sand for a couple of years, but ultimately the real estate bug kept biting at me, and I couldn't quiet it down. Right, I couldn't make it go away, and so in mid 2010, early 2011, I started getting back in, meaning like I was talking to people again that were still active in the space or had made it through the downturn or were new investors. There's two categories of people. They're the old timers that made it through, that just continued, even if they might have lost money, continued through. And they're on the other side. And they're the new investors that ultimately jumped in when there was blood in the streets, and they haven't been through the downturn. All they've seen is that upward trajectory, which was me back in 2002, right? All I saw was going up. And so I was trying to understand this new landscape that existed. Lending was different. Lending was very challenging in 2011. There was still a lot of distressed stuff out in the marketplace. And I didn't make a decision that I was not going to buy a single family. I needed to be able to rebuild and scale in a much bigger manner. And I wanted to scale a sustainable business. And based on the amount of time it took me to build the portfolio of single family properties, I didn't want to spend that much more time. I didn't want to spend that amount of time rebuilding what I had. And I felt like I'd do it bigger and better in apartments. And so that's what my focus was going to be. And I had owned apartments before. I had about 500 units. And so I understood that space. And as I was going on this journey of re-educating myself and getting comfortable with this new real estate landscape, I met a guy through a mutual friend that had been in the finance, the banking business for 30 years. His name was Randy. And Randy had been in the banking business, the commercial real estate, and he had specialized, at least for 15 years of his career, financing mobile home parks across the country. And I had no interest in mobile home parks, Larry. I wasn't going into to meeting with him, to pick his brain. I like meeting people, and I truly agree with the phrase that your net worth is your network. And so I had a lunch with Randy just to meet someone new, and I left that lunch, about 2-hour lunch, and had a newfound interest of mobile home parks. And Randy piqued my interest in many ways. And he wasn't really trying to sell me on them. He was just trying to help me understand why he liked them and why he chose that asset class. And a few different reasons. Number one, it's the only asset class that has a diminishing supply, meaning that there are more mobile home parks that get redeveloped or shut down every year than that get built. In the last, I don't have the statistics in front of me, but there was only about 7 or 8 mobile home parks that were brought online in the past 5 years, and probably hundreds that were redeveloped into something else. A lot of these were built in not so great, not so valuable pieces of land, on the outskirts of cities or towns that are now basically in the path of progress, or the town has surrounded it, right? And there's higher and better uses like, commercial redevelopment. And so that's one thing. Barrier to entry is important to me. Like that, to me, that's a huge barrier to entry. They're not building more of them. Another one is the minimal turnover that exists, because when they own the homes in these communities, they stay. I mean, it's costs a lot of money to move a single wide or double wide, more money than the average person that's seeking affordable housing has. And so these homes, once they get moved in, they very rarely ever leave that community. And so what happens is when someone wants to move, a resident wants to move, they typically put their home up for sale or the trailer up for sale, just like you would in your subdivision or like I would in my home. They pay their lot rent until someone else buys it and starts paying the lot rent. So you don't have that down period that you would in an apartment, right? You don't have like the 2-month span where you got a vacancy, you got to turn it over, release it, blah, blah, blah.
Right.
That doesn't exist. The management side of things, it's a lot less intensive than apartments. If they own their own home, we're not getting calls about their AC not working or their roof leaking or plumbing. Our only responsibility for the most part is the common areas and the infrastructure. So the water lines, the sewer lines, the common grounds. Sometimes we have an office inside the community. But really, that is the end of our responsibility for the most part. They're responsible for everything that happens inside their home. And then a few other things. I mean, there's a list, but one of the other big things is when we were, kind of comparing apartment complexes to mobile home parks, if you could compare apples to apples, like a 100-space mobile home park versus a 100-door apartment complex in the same city, same class of asset, meaning like maybe a C class, what kind of returns could we expect from one versus the other? And what we found, and what we have found even today, is that we can get a higher return on our investment with mobile home parks than we can by buying a similar size apartment complex in the same town. So many other reasons that exist in addition to those, but those are some of the really big ones. And those piqued my interest enough to where I left that lunch with Randy and basically dedicated the next 12 months to learning everything I could about this niche, and then ultimately buying a park. I'm like, I'm going to buy a park, and I want to either prove or disprove this asset class. Like, is it good? Is it a good fit for me? And can I make money? And I did that. And here we are today, I don't know, 20 parks or 20 some odd parks later, and we're in 11 different states. And that's our only focus now. So we like the park business.
That's awesome. Now that's called taking action. And I like what you said about your net worth is your network, right? So not many people really think about, networking with other people just to learn and grow and get new ideas, because I've said for years, a good idea doesn't care where it comes from, right? And you need to be networking with other people. So that alone, nothing to do with real estate, is a very, very good tip. When you meet somebody that's doing something that you either don't know how to do or don't know anything about it, take them to lunch, buy their lunch, right? It'll be well worth it. I mean, look at you. You got 20 plus projects in 11 different states now because of one lunch.
That's right? It. And I wasn't going into that lunch, Larry, excited about learning about his business per se. I was going just to meet someone. You never know who's going to be on the other side of that table or who's going to be on the other end of that line. The most humble individual is that like the guy that drives the beat up pickup truck that's your neighbor, right? For all you know, that guy could have sold a business 15 years ago and is worth $100 million, right? Like just be open, be approachable, speak to people, talk to people, get to know them, right? And just the value that gets uncovered from just putting yourself out there is so significant, and that alone will take you very far in life. So
absolutely. Now, you mentioned a couple of times a minute ago that you rent out I'm going to call it the pad, right? You rent out the space, and so your tenant actually owns their own home, so you don't have to worry about any repairs or anything. So why do you do that? And tell us how you manage that, because I'm sure you get some people that don't pay, but they also don't have the money to pull their trailer off the lot either.
Right.
So tell us a little bit about that whole model and structure.
Yeah. Now, I will, just to give absolute transparency here. We do own, give or take, the number changes every day, about 150 individual mobile homes inside our communities. Some communities we own none. Some of our communities are 100% resident owned. Other communities we have, maybe a handful, and some communities, I think the most that we own in one community is probably about 25 homes, maybe a little bit more than that. And the only reason that we own them is because the prior owner, he liked the rental model. So like, basically just like an apartment, he'd rent the mobile home unit to someone on an annual lease, and that's how they ran it. And so when we acquired the park, we acquired their business model, but we ultimately try to change it and try to sell those homes off to deserving families that want to be a homeowner versus just a continual renter. And so the reason why we don't like that business model so much, it's much more management intensive. For some of the reasons I mentioned earlier, you got turnover. When someone leaves, they don't always leave the place in the best condition. You've got, carpets and floors that you've got to replace. You've got drywall repairs. You've got paint. You have downtime. And downtime equals loss of revenue. A 200 space park where we own none of the homes is about the same amount to manage as a 40 space park where we own all the homes. Wow. So the management intensity is significant. I mean, the ACs are always breaking, roofs are always leaking, plumbing backups. Right. I mean, it's a forever reoccurring, maintenance issue when you own those units. And so we don't love it. And so in any event, I forget the original question. I lost my train of thought there, but that's why we don't like that side of the business model. So we're always working towards selling these units back to the renter. If they're a good renter, they've been there a while. If they tell us that they want to be a homeowner, we create very easy financing terms for them to essentially take the responsibility of that unit. Every state's a little different, but essentially like a rent-to-own model, and ultimately get them into a position where they can own it in a very short period of time. On average, 5 years or so.
That's really good. Now, how do you handle the delinquency? Because with the mobile home park, I mean,
that's right. That was the other question.
Naturally, it's, and I don't know if this is the right terminology or not, but naturally, it's probably a lower quality of clientele that you're dealing with.
Not necessarily. No, and I'm going to let me hit on that point, and then I'll answer your question about how we handle delinquency when they own the home. Sure. I like to use the comparison of, in any city where, I don't know Lake Wylie, South Carolina, but I'm assuming that you guys have apartment complexes in town, you have residential neighborhoods, and you probably have some mobile home parks, within a 30-mile radius of where you live, sure. Right? You can go in any part of your town and probably find a D-grade apartment complex that's run very poorly, that's full of, the wrong elements. And in a different part of that same town, you can find an A class, right? In a different part of the town, you can find a B or C class, which is full of blue collar individuals. The A class is full of white collar individuals. Same thing with residential neighborhoods. You've got nice neighborhoods, which are the high end. You've got the blue collar neighborhoods, single family homes, and you got the rough neighborhood, which your parents tell you to stay away from, right? Same thing exists in mobile home parks. We've got the entire spectrum here. Unfortunately, we've kind of been lumped into the category of like we're all bad, but we own some communities that are gorgeous. We own some communities that literally the mobile homes, you could more affordably live outside of our mobile home community in the same town, literally the same village, as you could inside our community. And the people that live in our community live there because they like the community aspect, and they've got really nice homes that are $100,000+. And we have a lot of blue collar type communities that are just good, hardworking folks that want an affordable place to live. And then the other side that we don't own are D class, mobile home parks, like the trailers, the trailer parks of the world that are just fill it up with the bad elements, the rough crowd. They're in the bad part of town. So I want to make sure I make that point there. It really depends on your model and who you like dealing with, the demographic. But if you like dealing with, responsible people that pay their bills on time, you surely find those in our niche. And so back to the delinquency, that's one of the cool things about this space is if they own their own home and they don't pay their lot rent, they have a lot to lose. For the most part, the folks that live in mobile home communities in general, not just ours, but in general, that's their home, their trailer is probably the most valuable asset that they own other than their vehicle, right? Even if it's only worth $10,000, it's probably still the most valuable asset they own. And if they lose that, let's say, across the board, the nation, the average lot rents are about $300 a month. I mean, California, there's lot rents of $1,000. Florida, we have some as well. But, there's some parts in South Carolina, North Carolina where lot rents are as low as $150 a month. But just across the board, on average, assume $300 a month lot rent. That's pretty standard. There's no part in any city, any town, to where if that person owns their own trailer, if they're only paying $300 a month lot rent, to where if they lose that roof over their head, that they're going to find to live for $300 a month at all. Like, it's just not, like, it's not possible, especially if they have a family. Maybe they can go rent a room in a boarding house for $300 a month. And so I guess where I'm going with this is they've got an asset that they're going to lose, but the most valuable thing they own. Most folks that own their home figure out a way to make that $300 a month lot rent payment, because they run the risk of losing their home if not. And we've only had one situation. We're very black and white in our collections policy, like no pay, no stay. We don't give breaks. We run a business, and we've only ever had one eviction in a situation where the resident owned their home. And it was an anomaly. The guy literally lived there for 8 years, paid on time all the time, and didn't pay 1 month. And the manager went to the door. He wasn't home, went to the door again a couple days later, a couple weeks later, a couple months. The guy disappeared. We called the local hospitals, jails, prisons. We couldn't track this guy down. He literally disappeared. And after like 5 months, we had to go through the eviction process, and that unit became abandoned, and we took back the ownership of it. And then we ultimately renovated it and sold it, to someone else that wanted to live there. So that's the only situation where we've ever had to evict somebody that owned their own home. And so it doesn't happen often, because they've got so much to lose. They just have so much to lose.
Right. Wow. That's really interesting that, out of all the different units that you have, that, and as long as you've done this, that you've only had one.
We've got 2,000 units, and we've sold some parks. And so, I mean, we've owned a lot. One. And it was a very unique case. It wasn't just the case of irresponsible person not wanting to pay their lot rent. If a person, where there's a will, there's a way, and $300 a month is not a lot of money to figure out how to come up with. I mean, you could go to CVS, buy a case of water for $2.99, which is, I still don't know how they sell that stuff that cheap, and go in the corner and sell those bottles for $1, right? And do that for the entire month, and you could easily make $300 doing that.
Right.
So most people figure it out.
That's good. But if they can't pay, you can have their mobile home pulled off the lot, right?
Yeah, that's what would happen essentially if they ultimately don't proactively sell their home, ahead of time, which that happens. If someone knows they're not going to be able to afford it, they just sell the home. But if they literally go through the eviction process and leave their home there, and they abandon, get out of town. Every state's a little different, but we go through what's essentially an abandoned title process, very similar to what would happen if someone like left a car at your house, or if you left your car at the impound. After a certain period of time, that impound can basically take ownership of it and get a new title reissued in their name. It's now their property. And we do the same thing. And every state's a little different. Some states it's fairly quick. It takes a couple months. Some states it can take 8-9 months. But it's not very expensive. Less than $1,000 for the most part. And then we take the home back, and then we have legal ownership, and we'll go in and renovate it, or, deciding, depending on the home, we'll like this, we only had it happen once. So we'll go in, and that one we renovated. It was worth saving. It wasn't that bad of shape. And then I think we turned around, we put about $3,000 into it, and we sold it for, I think $8,000, made $5,000, and, which basically helped us, recapture the lost rents. I think at the end of the day, we probably netted about $1,000 when you actually factor in the lost lot rents and things like that occurred. So, and then we got a new tenant in there. That person still lives there today. That was like 3 years ago. The same person lives there. They own the home free and clear, and they pay us $350 a month lot rent.
They don't go anywhere. That's for sure. Because they're not going to move their home to another park.
No, it costs, single wide on average. And this is assuming if they move something, to another community close by, a single wide on average. And this is the move and also resetting it back up at another community. And that means blocking it, leveling it, putting skirting all the way around. A lot of times you can't reuse skirting because it might be a higher elevation. It's not the right size anymore. You got to build new decks. You're talking, $5,000 to $7,000 when it's all said and done, getting utilities hooked up, getting your AC hooked back up, all that stuff. The average person that lives in a mobile home park doesn't have the $7,000, waiting to burn a hole in their pocket. It just doesn't.
That's true. What would you say is the average age of a mobile home in a park like that? And I'm sure there's some parks that were developed later than earlier, and some of them, once they get a certain age, you can't move them anyway. They don't allow for that.
Yeah, if they were built prior to 1978, that's when HUD got involved in the manufactured housing space. So if they were built prior to 78, they're legally not allowed to be moved anywhere. They're not roadworthy per the government. So anything prior to 78, they have to stay stationary. But it's kind of hard to give you the average age across the board. I mean, the average age of probably the homes in our communities, we've got some newer stuff, we've got some older, but probably like mid 80s to or late 80s to early 2000s.
Okay. Okay,
And
that's
then
good.
we
So
got
a
some
lot of
very
them,
new stuff and we got some old stuff, but like that's kind of middle of the pack.
a lot in the 90s. Yeah.
Yeah,
Yeah,
yeah.
that makes sense. That makes sense. Now, do you, as a park owner, do you ever, like, if you have an empty space, will you find a new mobile home maybe, or a mobile home, and move it on there and sell
Mhm.
it, and
Uh,
to get that buyer financing and all that third
Yep.
party financing, so you don't have to do it. So
Yep.
you create your own tenant and you make money on the mobile home.
Yeah, yeah, we do both. We'll bring in used homes. It depends on the park. It depends on the market and who the end buyer is going to be.
Right.
Um, Ideally, we like bringing new homes in because it kind of refreshes the community, right? If you just got a community full of old homes, at some point, it literally is just gonna like it's hard to make 40-year-old mobile homes look good. At least make
Right.
all of them
Right.
look
Right.
good. And so if you start bringing in newer mobile homes that have vinyl siding, shingle roofs, they have shutters, they look more like a traditional home. That definitely spruces up the community. So we'll bring new ones in. I can tell you that we don't try to make that much profit on the new home sale because really at the end of the day, like the value that we want is in the lot rent. Like that's really where the value is made. So we'll bring a new home in, we'll set it up. We've got some financing programs like in-house they're third party companies, but like we're set up with them as a whatever correspondent lender or whatever you want to call it. And so we have full blown sales programs with some of our communities with new homes, and we'll have single wides, some double wides, depending on the demographic we're serving and
Right.
what kind of price point they're looking for. And again, we don't try to make much money on the new home. Sometimes we'll even consider losing money on a new home sale if we've got a incredibly qualified tenant. Like if someone came in, if I had 40 grand into a new home and someone came in and said, I don't need financing. I got $38,000 cash. I just want to buy this thing. I want to live in the community, but I don't want to get financing, but I got 38 and I need to make that fit my budget. I would lose $2,000, especially if if they're paying cash for it. Cause I know they're not going anywhere anytime soon. There's no risk of them even going into default on a mortgage at that point because they don't have a loan on it.
Right.
So,
Right. Right.
um,
That's huge, man. I love that.
yeah, yeah.
I love it. That's awesome. That is awesome. That's good stuff. Let's talk a little bit about the utilities, because
Mhm.
I know some parks have their own utility company, whether it be water,
Mhm.
or whatever. So talk a little bit about that, because I'm sure that's an extra income source as well.
It can be. We don't. I don't think we try to get our costs back. So we've purchased some parks to where they actually make money on their utilities. But what I found is that if you're really honest with yourself and you don't defer maintenance in your community, and like if you have a well systems don't run forever without needing repairs and maintenance, right? And so if you're adding a little bit of and if you're allowed to, not every state or every county allows this, and so some people do it illegally. But if you're adding some type of premium in there for the cost, you still have the repairs and maintenance. You have a licensed operator a lot of times has to maintain that system. There's not a lot of profit margin there. Some folks might lie to themselves on their profit and loss statement, but there's really at the end of the day, like that's not where the big profit center is. You might make a little bit, but not enough to change your life. And
Right.
same thing with the sewer. We've bought parks that are on private sewer systems where the old owner, tried to charge a premium. And what we found is that a lot of times that premium just really helps basically pay for the licensed operator, for the reserves that we set aside for future big capital expenditures that might happen to the system. And it's really just more of a break even. If you're lucky, it's a break even side of the business. So, but with that being said, I'm not saying you can't make profit in utilities. It's just not the amount of headache and regulatory issues involved with trying to profit on private utilities,
Right.
sometimes not worth the brain damage. But speaking to utilities, there's different types. Ideally, it would be municipal or city provided water and sewer. That's the most simple and straightforward. You don't have to worry about the quality of the water because it's the city or the town. The sewer system, again, you don't have to really worry about what they do with the the waste once it makes it to the plant.
Right.
Not your responsibility. Whereas if you got a private well, now you're in charge of not poisoning people, right? Giving them clean drinking water.
Right.
You got to be responsible for that. There's some risk there, but there's licensed operators out there, and we don't do it ourselves. We don't have our managers do it. I know people that do. They'll get certified. They'll have their manager get certified. We're surely not putting that responsibility in the hands of our managers, because at the end of the day, you can't poison someone with the sewer unless they go and drink out of the sewer. But you surely can poison somebody with a well if you don't stay on top of it. And
Sure.
I think that's a big risk. So we always have licensed operators manage that stuff for us. And then on the sewer side, there's different types of private systems. There's, the traditional septic tank system. You've got lagoons, which you don't see too much of anymore, which are basically large cesspools. And then you've got, package plants or sewer treatment plants that is basically a miniaturized version of, what your town or municipality uses to treat the sewage. And you have those on site. And we only own one of those today, like the actual treatment plants. We just bought a park with one. And we're about to buy another park with a sewage treatment plant. And we own a number of parks with septic systems. We own a few wells. But for the most part, we have municipal utilities. Again, it's just from a risk perspective and just ongoing operations cost, it's much easier and straightforward to have municipal utilities. But with that, there's lots of parks on private systems that are great opportunities.
Yeah, that's good. That's good. Now, tell us a little bit about if somebody wanted to get started in this, what would be like, I'm sure you haven't done as many as you've done. There's probably like an ideal size or a good starting point for somebody to get into this space. What would you recommend somebody wanting to get started?
Yeah, it's really, I'll back up a little bit. Kind of how our management structure works is, since we own communities in many different states, and we're not visiting them every week, we have on-site community managers. Sometimes they live in the community, sometimes they're outside, but they're very close. But they handle the day-to-day operations. They handle the rent collections, eviction notices, meeting vendors, all that stuff, right? I mean, just all the day-to-day daily grind, they handle it. And so you get what you pay for as far as a community manager. If you're only willing to pay someone, minimum wage, you're going to get minimum wage, right? And so I like to say that you should probably choose a mobile home community. If you don't intend to manage it yourself, meaning like if you don't plan to live there or be there every day, like you want someone else to kind of handle the day-to-day stuff and the collections, you need to have someone competent there to manage that day-to-day operation. And the park needs to produce enough revenue for you to be able to hire someone that's competent. And every location, every market's a little different, but I found that if you can pay someone the equivalent of, $15 an hour, and every park's a little different, how much time that's going to require on a weekly basis to manage it and to do the day-to-day operations. But most of the time it's not full-time unless it's a, 80 or 100 plus space park. Most of the time it's a part-time job, but you got to be able to pay someone $15 an hour. So, and if you can't do that, then you're not going to get someone that's competent. So, the normal size that can accomplish that you can justify paying someone $15 an hour is normally about 40 to 50 lots. Now, if it's a park that's in like, the outside extreme to that would be if it's a park in like, Boston, Massachusetts, where lot rents are $700 a month, then you could probably manage that same thing on a 20 lot park, right? Because your revenue on that 20 lot park, because your lot rents are so high, is just as high as a park that's 40 or 50 spaces. That's $300 a month. So 40 or 50, I'd say across the board, generally speaking, is about the size you should be looking at. Not that you can't make money with smaller ones, not that you can't make it work, not that you can't find a competent manager for $10 an hour, but it depends on how much brain damage you want and how much freedom you want that community to create for you. It's the best way to put it.
That's really good. That's some good info right there. So tell us a little bit about putting these deals together. I'm assuming you probably do some syndication to raise money for these type of projects.
We do. The first, I think 6 or 7 communities that we purchased, we didn't. Most of them we used either, I had one other partner, we used our own money. We had some private lenders that we still had good relationships with from our, back from our single family days. And so most of the first, batch that we did over the first couple of years was all of our own money. And we really did that for a multitude of reasons. Number one, we wanted to put our own money to work. We wanted to prove the concept. We didn't want to go risking investor capital with a kind of an unknown entity at that point, right? Right. And so we did that. We kind of proved the concept. refined our systems, refined our focus, kind of how we wanted to take a bigger stab at this piece of the pie or this niche. And then 2.5 years ago, maybe 3 now, we basically formalized our company, put a business model in place where we're raising capital. And so we don't do it deal by deal. We do it in a fund structure. So we're rounding out a second mobile home park fund. We opened one last year. And we bought a number of communities. We opened one this year. This year, it's a $20 million raise of equity, and we'll close out the current fund we're in here in the next 6 months or so. And then we've got a third mobile home park fund that will open up and again bring capital in as equity and just keep the buying machine going. So we decided to go with a fund structure for the syndication to where we buy multiple properties underneath one entity, because we're pretty confident our pipeline. We do a lot of the same marketing methods that a lot of the residential guys do, the big time guys that are doing multiple hundred deals a year. We do a lot of direct mail. We do a lot of cold calling. We have a full-time cold caller in house. Work with brokers as well. And so our pipeline's always got deals in it. We've got stuff that falls apart, but we've always got a pretty healthy pipeline. So we decided the fund structure was much more efficient. We could buy multiple properties at once than doing one at a time. And the legal cost with a individual syndication is just as much as it is with a fund syndication. And so it allows us to kind of spread that out amongst multiple properties.
That's good. That's good. Are you able to share a little bit about what kind of returns the fund is generating?
Yeah, absolutely. So right now we're in the middle of our second capital raise of our mobile home park growth and income fund 2. It's a slightly different structure than our first fund was, and we'll probably make some tweaks to it again next year. But ultimately, there's a pref involved depending on how much capital the investor puts in. It's for accredited investors only. 8% pref is the minimum. That someone can get up to a 10% pref if they put in $500,000 or more. And then essentially it's a 50-50 split after the pref is met. And so our projected returns, and we actually have a clawback provision in our operating agreement, which allows there's no guarantee, but it's the closest thing to a guarantee possible. So the clawback provision basically states that our investors will achieve a annualized return of 12%, during the life of that investment or those investments inside that fund. If they don't, at the end, when we divest of these properties, let's say it's year 8, and we sell everything off of, we haven't met their annualized 12% return in those 8 years. Every year for those 8 years, they get to take it back from our general partner side before we receive any profits. They get to pull back from us to basically level out at the 12%. So 12%, to answer your question, 12% is what our investors can expect.
So they get an 8% preferred, which
8, 9, or 10, depending on their level of investment. Yeah, so 8% is the minimum. If they put in basically $250,000 to $500,000, they get a 9, and anyone that puts in over $500,000 gets a 10% pref. So it just really depends on their level of investment. Right.
That's good. Well, 8 pref is pretty good. A lot of people do 6, so that's pretty good.
Yeah, no, absolutely. Yeah, and you can actually see, all the investor the apartment guys, deals are, even in mobile home park space, deals are getting harder to come by. The returns are getting squeezed a little bit. And so you'll see who might have been doing an 8 pref, 3 years ago now is doing a 6 pref. They have to in order to make the deal work, in order to be able to get their investors paid, and also for them to make some money in the deal. So, we've also made tweaks to our fund structure from our first fund to this fund. We're setting up the paperwork for our third fund that will be rolling out here in a little bit. It'll be a slightly different structure as well.
Right.
But the whole goal is all of our investors are our partners. We're directly aligned with them. We're really looking what's in their best interest, and we truly are grateful for every investor we have. We wouldn't be where we're at today, and we wouldn't be able to do what we're doing if it wasn't for those partners that we have. And so we're always first and foremost, when we put the plan together for the structure itself, it's what's the market doing, what are our competitors doing, and also, what is it that our investors really want? What are they expecting? What are their expectations? And how can we directly align ourselves and our structure with their expectations and actually meet it?
Right.
So.
That's good. So tell us a little bit about how you go about, I know you mentioned you've got somebody on the phone, you do some direct mail, but what are some of the best ways to find mobile home parks?
Yeah, I mean, there's some listing sites out there. I mean, everyone knows about LoopNet, which is the basically commercial MLS. We have bought a few things off LoopNet. I kind of classify LoopNet as it's the broker trash can, right? Like if they're most 99% of commercial deals, this is generally speaking, 99% of commercial real estate transaction happen off market, meaning that it's a broker has a relationship with a seller, and then that broker also finds a buyer. The transaction happens, and Larry, you and I don't even know, right? It was never listed on an MLS. It wasn't posted for sale. It just happens behind the scenes. Whereas residential, probably 99% happen on market, right? They get on the MLS and they go for sale that way.
Right.
And so LoopNet's not the great place because normally that's like the Hail Mary pass for the broker. They've kind of shopped it around. Either it's too expensive, there's some challenges with it, it's in a bad market, and their buyers list hasn't bought it. And so then they put it out to the world to see on LoopNet. So LoopNet's not the best place for deals. There's also a website called mobilehomeparkstore.com, which is a listing site for mobile home parks. Also, we've never bought anything off the site. We look at it every day. We have for 5 years. Still can't find anything. The owners of that website, the owners of that website are big investors, mobile home park investors, and I'm pretty sure they cherry pick everything before it gets posted to the public, which is good for them. I like the business model.
Or it's them selling.
Right. And so to get back to the original question, you can search those sites, but really brokers are a good option. Building those relationships with industry brokers. We have a number of them in our space that's all they do. Also, direct to owner marketing, just like a lot of your listeners are probably familiar with. We talked about direct mail, getting a direct mail campaign put together, mailing directly to owners within a particular target region or market, picking up the phone and cold calling them, right? If they're local to you, meet them, schedule a lunchtime with them, go visit them if they actually work inside the community at the office, or, go meet with them. You'll find a lot of these owners are old mom and pops, and you'd be surprised. Like, you find the guy that he owns a park that's worth $5 million, and he literally lives in it. He lives in one of the trailers. Go meet with a guy. So it's really all about getting direct to those owners, if possible, and then also utilizing brokers as well. But about 90% of our deals, and we've been doing this a long time, so we've got good broker relationships, and we look at a lot of broker deals.
Right.
But broker deals, it goes to the mass market, and there's always someone willing to pay more than you for it, right? And so you get into this like bidding war, and you end up overpaying for stuff. And so 90% of the stuff we buy that we've bought to date has been direct to owner. We've sourced it ourselves, and we don't get into that bidding war. We get things for fair prices, and a lot of times we get to negotiate some good terms like seller financing or interest only periods and all that kind of good stuff.
That's really good, man. This has been some really, really good stuff. I really appreciate you sharing a lot of good information. One question that I've been thinking of is, do you or have you ever, or what are the benefits of developing your own park? Because it's really just the infrastructure, just putting in the, clear grade gravel pave, put the utilities and the pads in.
Yeah. A couple of different things is, number one, if you're talking about doing this in any developed town or city, the chances of you getting approval from the town or the city to do so is less than zero.
Wow.
I mean, it's just, just like you thought that, mobile home parks would mean dealing with challenging tenant base. Municipalities and towns feel the same way. And so like the last thing they want is to have another mobile home park in their backyard, because some of the ones that are probably in town already probably aren't run properly, right? They probably got some bad elements to them. So the chances of getting approval for that, unless it's out in like the middle of a rural area, is next to none. And even if you could get approval, there's plenty of parks that exist out there today that already have the infrastructure in place that are being mismanaged, that you can essentially pick up for less than replacement cost, less than it would cost you to develop them. And they already have some cash flow in place. And so if you went and actually developed your own park, not only do you have the risk of you have the uphill battle of getting approval, then you've got the risk associated with developing, having that debt and the time period associated with developing a piece of property.
Right.
And once you're said and done, you still have to fill it with people that are willing to move their homes in and pay a lot rent. Or you've got to put in a new home sales program, and literally the break-even time period, it would take quite a while to get to where you've got, 30, 40% occupancy where you're actually breaking even, so like you got a long road ahead of you of negative cash flow and basically supporting this massive debt beast. So that's why developing is it's not the best plan today. And about the only time it really is is if you're going to develop, a very high end community, and like the parks that really get developed today typically are parks that are in like Florida, and they're not affordable housing. They're lifestyle communities that, they got palm tree lined streets. They got 3 swimming pools. The people that live there have other homes up in the north. It's like their summer or their winter getaway. It's a snowbird type thing,
or a 55 plus type place.
That's it. Yeah. Again, they've got activities directors. I mean, it's more of a lifestyle choice than it is, I need a affordable place to live. So those are the types of things they typically build. And we're talking about huge projects at that point, but, and then you can surely make money there, but that's not our niches. There's plenty out there that need work, that are good value add plays that, that we can buy for below replacement cost, and we can get in and have cash flow right away and add a lot more to it along, down the road. So
good. That's good. Well, man, I really appreciate you being on. If somebody wanted to reach out to you and connect with you, check out your podcast or whatever, how would they do that?
Yeah, so I've got 2 different places I can be reached. Our company website, in case anyone wants to know what we're doing, or you can contact me through there as well. It's sunrisecapitalinvestors.com. And then my personal website is kevinbupp.com. And on my personal website, I also host my Real Estate Investing for Cash Flow podcast. They can listen to them there. They can find them in iTunes. And then we've also got a mobile home park investing podcast that you can find on iTunes or Stitcher, and I think a variety of other places as well. So any of those ways they can reach me. I'm not too hard to find. Just like you, Larry, we can be tracked down pretty easy. We can't hide anymore. But this whole fancy internet thing, right?
I know, right? We're out there.
Yeah,
for sure. Well, buddy, I really appreciate you being on, and thank you so much for sharing. It's been a lot of good information.
Yeah, thanks for having me, Larry. It's been an absolute pleasure. So you take care.
Thanks a lot, everybody, for watching. Appreciate it. Thank you, and be sure and share the video and leave us some feedback, and we appreciate it. Thanks a lot. See you later, Kevin.